Welcome back to the Deep Dive. It is early February 2026. If you've been scrolling through your feeds or glancing at the headlines this week, you're probably seeing the usual suspects.
Mm-hmm.
You know, the massive AI breakthroughs, the flashy demos, the questions about when the next interest rate cut is coming. It's the loud stuff.
Right.
But today, we are doing something a little different. We are ignoring the noise to look at the plumbing.
The plumbing.
The plumbing of the global economy. Because if you look at the stack of sources we have this week, articles from Reuters, deep dives from Tom's Hardware, and a very, very dense report from the US Treasury, the real story isn't happening on the front page.
No, it's happening in the messy layers underneath.
Exactly.
That is a fair assessment.
Yeah.
If I had to put a label on the theme for this week, I'd say we're finally moving past the AI hype phase of 2024 and 2025.
Okay.
We are firmly in what I'd call the infrastructure reality phase.
Infrastructure reality. I like that. Sounds
Yeah.
expensive.
It is expensive, but more importantly, it's physically constraining. We've spent 2 years thinking about software potential, but now we're hitting hard walls. In the chip world, it's no longer just about magical code. It's about physical factory floor space.
Right.
And in the financial world, specifically looking at Japan, it's no longer just about interest rate percentages. It's about government spending budgets.
So we have two distinct but weirdly connected deep dives today. First, the hidden winners of the AI memory boom. And spoiler, it is not the giant companies you probably have in your portfolio.
Not at all.
And second, a massive subtle shift in how the U.S. government is viewing Japan's economy, which might completely change how you look at currency risk.
And both of these stories, they tell us the same thing.
Yeah.
The easy narratives are dead. The landscape has shifted under our feet. And if you're still using the 2025 playbook, you're going to miss what's happening.
Okay, let's unpack this. We're going to start with the hardware. When most people think about betting on the AI boom in 2026, they think of the big three in memory, right?
Right. Samsung, SK Hynix, Micron.
Exactly. If you want memory chips, you go to the Titans.
Traditionally, yes, they control the vast majority of the market share. But if you dig into the supply chain reports from the last few weeks, specifically the analysis coming out of Reuters and Tom's Hardware, there's a huge surge in interest around the small and medium enterprises.
Yeah, okay, so not the giants.
No, we're talking about companies like PowerChip, also known as PSMC and Nanya.
PowerChip and Nanya. I'll be honest, those aren't exactly household names like Samsung, so why are they suddenly the bells of the ball?
Well, the catalyst was a specific event in mid-January 2026. We saw Micron, one of those massive big three giants, announce the acquisition of PowerChip's P5 fab.
And a fab is just a fabrication plant, a giant factory.
Correct. So Micron bought this factory in Taiwan for roughly $1.8 billion. Now, on the surface, that just looks like a standard business deal, a big fish eating a little fish. But sources all highlight that this triggered a realization in the market.
That it was more than that.
It was more than that. This wasn't just an expansion. It was a desperate grab for capacity.
Desperate? I mean, Micron is a massive company. Why would they be desperate for a factory owned by a smaller player? Can't they just build their own?
They can. But building a fab takes 3 to 4 years. Micron needs space now. This deal signaled that the memory tightening we've been hearing about isn't just a normal price cycle where demand goes up a little bit. It's a fundamental reshuffling of the entire supply chain.
So to understand why the small players are winning, we have to understand what broke the supply chain for the big guys.
Exactly. We call it the vacuum effect.
Okay, paint the picture for me. What is being vacuumed?
Capacity.
Yeah.
Just think about what AI actually requires. It needs HBM high bandwidth memory.
Right, this isn't your standard memory stick.
No, this is premium, ultra-fast, stacked memory that sits right next to the NVIDIA GPUs. The demand for this is, well, it's insatiable. Every data center, every government, every tech giant is fighting for it.
Okay, so the demand is through the roof.
So what are the big three doing? Samsung, SK, Micron? They're taking all their production lines, all their best engineers, all their capital, and they are reallocating them to HBM to serve the AI overlords.
They're retrofitting their existing factories to make this high-end stuff.
Right. They're chasing the highest margin product. That makes sense.
It makes perfect business sense. But here's the problem. The world still needs standard memory.
Exactly.
We still need BDR4 and DDR5 for our laptops, our cars, our smart fridges, our Wi-Fi routers. We call this legacy DRAM.
And when the big three pivot their factories to HBM, they leave a massive hole in the supply for that legacy DRAM.
I see where this is going. It's like, Okay, imagine if all the major airlines decided, you know what, first-class tickets are so profitable, we're only going to fly private jets and luxury liners.
That's a perfect analogy.
So Delta and United stop flying economy, they just rip out the seats.
Yep.
Suddenly, the regional bus lines, which used to be unglamorous and cheap, are the only way to get from point A to point B.
And suddenly, those bus tickets become incredibly valuable. That is exactly what is happening to PowerChip and Nanya. The sources describe them as becoming hidden winners because the big guys have effectively abandoned the legacy turf.
So the market stays tight for longer?
Much longer.
Mm.
Tom's Hardware points out that because AI is sucking up all the oxygen, the period where supply was supposed to get loose or abundant again is being pushed further and further out.
Which introduces this concept you mentioned from the Reuters analysis, option on capacity.
Yes, option on capacity. It sounds a bit technical, but it's really just a way of looking at these factories as strategic assets.
Okay.
If you are a big tech company, say a PC maker or a car manufacturer, and you can't get production line time at Samsung because they're busy making HBM for AI, where do you go?
You have to go to PowerChip, you go to Nanya.
Exactly. Their factory floor space becomes an option you have to exercise just to get your product made.
It's so interesting because usually in tech, the investment thesis is own the cutting edge. You want the newest, fastest thing. But here, the value is accruing to the guys making the old stuff, simply because the big guys are too busy to bother with it.
Scarcity creates value, even in legacy technology. Maybe especially in legacy technology when nobody is building new factories for it.
So the chip companies, big and small, seem to be doing okay. But let's look at the other side of the coin. If memory is tight and expensive, someone has to be paying the bill.
Right. It can't just be free money. And that leads us to the second major theme in the sources, the global memory crunch. And this isn't just a catchy headline. It was specifically referenced in relation to the February 2026 corporate guidance.
Yeah, I was reading the notes on this. It seems like the pain is really moving from Wall Street to Main Street.
It is. We have data points from early February regarding companies like Qualcomm and Microchip Technology. According to Reuters, these companies are reporting that memory shortages and price spikes are actually hurting their shipment guidance.
That's significant. Qualcomm creates the chips that go into basically every premium smartphone. If they are hurting, that means the phone makers are hurting.
And it trickles down to you, the consumer. The sources are explicit about this. The crunch is driving up costs for smartphones, PCs, and especially lower to mid-range electronics.
That makes sense. If I'm a big phone maker, I can probably absorb a little extra cost on a $1,200 phone. But if I'm making a budget laptop,
Your margins get wiped out. If memory costs double, you can't just double the price of a $300 Chromebook. You either stop making it or you lose money.
and the sources mention this interesting behavior from the big three, they're trying to prevent hoarding.
Hoarding. It's exactly like buying toilet paper in a pandemic.
Right.
Everyone knows a shortage is here, so every electronics maker is trying to double order to build up inventory. But the big three have caught on. They've instituted what is essentially a VIP access system.
So how does one become a VIP in the chip world?
You buy AI chips. If you are a key AI client, you get priority allocation. You get to the front of the line.
And everyone else, the car makers, the washing machine makers.
They're scrambling. They're fighting for scraps or paying a massive premium to the smaller players we just talked about.
This really does feel like a structural change, not just a blip.
It is. That's the key takeaway here. Think about 2024. The bottleneck in AI used to be the GPU. Getting your hands on an NVIDIA chip was impossible. Now the bottleneck has moved. It's the memory required to feed the GPU and the memory required to build everything else. That bottleneck is causing a traffic jam that backs up all the way to your washing machine.
So if you're listening to this and thinking about investments, the sources suggest looking beyond the GPU trade.
Right, the easy money there might have been made. The sources suggest looking at utilization leverage. Small companies benefit massively when their factories go from 80% full to 100% full. That's where the profit explosion happens.
Okay, so that's the physical infrastructure, the chips. Scarcity is the name of the game there. Now I want to pivot to the financial infrastructure. We're going to talk about Japan, the yen, and a fascinating report from the US Treasury.
And this connects perfectly because, just like in chips, the easy narrative regarding the yen, it's falling apart.
So let's set the scene. It's January 29, 2026. The US Treasury releases its semi-annual foreign exchange report. Usually, this is a pretty dry document.
Yeah. Bureaucrats rating to bureaucrats. Most people sleep through it.
But this year, it made waves.
It did. The headline news was that Japan was put back on the monitoring list.
Which is basically the naughty list for currency practices.
Effectively, yes. They joined China, Korea, a few others. But being on the list isn't the interesting part. Japan has been on and off that list before.
Right.
The interesting part is why they are on the list this time.
And this is where it gets really interesting. For years, the narrative has been consistent. The U.S. would look at a weak yen and say, hey, Bank of Japan, your interest rates are too low. Tighten up your monetary policy.
Exactly. It was always about the central bank, the BOJ. The US Treasury was essentially saying, stop printing cheap money.
But this report from early 2026.
A complete 180. The sources highlight that the new report removed the demand for BOJ tightening.
Yeah, I took it out.
Gone. Instead, the report explicitly blames Japan's fiscal policy for the weak yen.
Okay, wait. I want to make sure everyone understands the distinction here because it's crucial. Monetary policy is interest rates. That's the central bank's job. Fiscal policy is government spending. That's the politician's job.
Correct. So the US Treasury is now saying the yen isn't weak because rates are low. The yen is weak because the Japanese government is spending too much money.
That is a huge shift in blame. Why the sudden change of heart? Why stop blaming the central bank?
Well, you just have to look at the facts. The notes here point out that the Bank of Japan actually did try to help. In December 2025, they raised rates to 0.75%.
Which for Japan is actually significant tightening. That's a real move.
It is. They held them there in January 2026, and yet the yen stayed weak. The US Treasury realized that you can't fix a currency with interest rates if the government is pumping massive amounts of stimulus into the economy at the same time.
It's like driving a car where one person is slamming on the brakes
That's the central bank trying to stop inflation.
and the passenger's reaching over and stomping on the gas pedal.
That is the perfect metaphor, and that's the government spending money. The sources bring up the political dimension here, specifically Prime Minister Sana Takaichi.
Right, her name pops up in the Reuters reports. What's her role in this tug of war?
Well, during the elections, she was loudly touting the benefits of a weak yen to boost exports. If the yen is cheap, Japanese cars are cheaper for Americans to buy.
Good for corporations.
Right. But meanwhile, her own Ministry of Finance is threatening to intervene in the market to strengthen the yen because imports are getting too expensive for Japanese people.
It sounds like a complete mess. You have the prime minister effectively saying, let it drop, the finance ministry saying, we will stop it from dropping, and the central bank saying, we are raising rates.
It's a completely confused policy mix. And that confusion creates volatility. The US Treasury report acknowledges this. By shifting the blame to fiscal policy, the U.S. is signaling that they are watching the government's budget deficit, not just the interest rate decisions.
They're calling out the lack of discipline.
Exactly.
So what does this all mean for someone watching from the outside? If I'm looking at the yen or investing in Japanese assets, how does this change my calculus?
It means the yen is no longer just a proxy for interest rates. You can't just look at the spread between U.S. Treasuries and Japanese bonds and trade off that. The yen has become what we call a composite asset.
The composite asset, break that down.
It just means the price of the yen now reflects fiscal deficits, political instability, and intervention risk all wrapped into one. The risk profile has changed completely. It's much heavier on the political risk than it used to be.
It seems like in both of our segments today, chips and currency, the lesson is that you have to look deeper than the headline.
Absolutely. If we connect this to the bigger picture, in both cases, the standard metric is failing us.
In chips, the headline is, buy the biggest company. But the reality is, buy the bottleneck.
Correct. You can't just buy the giant. You have to find the small player who owns the capacity that the giant needs. The leverage has moved down the chain.
And in currency, the headline is, watch the central bank. But the reality is, watch the government budget.
Exactly. You can't just watch the interest rate decision. You have to watch the political rhetoric and the spending bills. The central bank has lost its ability to steer the ship alone.
So practically speaking, based on these sources, what are the takeaways? For Feb 2026, what am I specifically looking for?
For chips, the sources suggest watching that utilization leverage. That's the fancy term for how full the factory is. When a company like PowerChip goes from having empty machines to being fully booked, their profit margins don't just go up linearly, they explode.
Because their fixed costs are already paid for. Every extra chip is pure profit.
Precisely. And for Japan, beware of intervention risk. Now that the U.S. has acknowledged the volatility and linked it to government spending, the stakes for currency intervention are higher. The market is waiting for the Ministry of Finance to step in, and if or when they do, it's going to be violent.
It won't be a gentle correction.
Not at all.
It's funny, looking through the notes, there was a quote that I think applies to both situations. The question isn't how long will it be tight, but who builds capacity with the most discipline.
That's the key. Whether it's building chip factories or managing a national budget, discipline is currently the most undervalued asset in the world. We spent the last decade in a world of abundance, infinite cheap money, infinite scalability of software.
And now?
Now we are back to hard limits. That's the infrastructure reality we talked about at the start. You can code an AI in a basement, but you can't code a factory. And you can't code a balanced budget.
Right. Those things take physical resources and political will. So to recap for our listeners before we let you go, we have the hidden winners in Chip's power chip, Nanya stepping into the legacy void left by the AI pivot.
The big guys are busy with luxury jets, so the regional bus lines are booming.
And we have the US Treasury changing the rules of the game with Japan, explicitly blaming fiscal spending for the weak yen, forcing us to look at politics, not just bankers.
Yeah.
I want to leave you with a final thought, something to chew on that comes from reading between the lines of these reports. If the global memory crunch is causing shortages in basic electronics right now, in early 2026, and the yen is being destabilized by government spending, are we entering a period where scarcity of physical chips and discipline of government budgets become the only metrics that actually matter?
It's a sobering thought.
Yeah.
We might be leaving the era of abundance and entering the era of allocation. Who gets the chips? Who gets the stable currency?
Who gets the VIP access?
Exactly.
That is all the time we have for this deep dive. Thank you for joining us as we try to find the signal in all that noise.
Thanks for listening.
We'll see you next time.